Well, excited to have Shane Cormier talk to us today. He's a CPA and an MCC. I'm not sure again what that means.
Oh, Masters in Accountancy.
Masters in Accountancy. Wow. But he started his life as a race car driver, and he with Joe Gibbs and many other famous people, and worked at even Grumman Aviation, right?
Mhm.
And was it project analysis? What was it?
Northrop Grumman, I was the assistant manager of ground support and tooling, and for Boeing, it was on the F-18 program.
Okay. Wow.
Wow.
Fantastic stuff. So he's not, I met him through Team JAS. He was the CFO for Andy St. Filippo for years and did a great job. And so it's great to have him connect with us. He's now a member of another Wise Counsel group, but he's a consultant, helps businesses analyze where they're at in terms of transition and buy, sell, and that kind of thing. So let's give him a big round of applause for being here. Thank you. Go ahead, take it away,
Okay.
Shane.
All right. Well, let's go ahead and jump right in. Excuse me. Go ahead and flip to the next slide. Oh, yeah. So the first thing that I would tell you guys is to, and let me preface by saying this. This is very conversational. If you have a question or I use an acronym or anything like that, you just stop me. There's no reason for me to have to go through the whole thing. I'll tell you that in the world of transactions on businesses, there's probably a limited number of ways to really get it done right, but there's many ways to do it. So I don't have all the answers, but I love talking about these things and being helpful, so we'll jump right into it. So timing. Ideally, and I forget who said it, it might have been Dean or Danny.
It was Danny.
Or Danny. Start thinking about it as soon as you can. You know, ideally, if you could think about a project and how you would want it to start and complete with great success, that's the finish. You would want to be thinking about how it's going to finish and what that means for you and your family, your employees. What time is acceptable? Acceptable is at least 6 months to a year. 6 months is kind of lean to actually get something done and go to market and do it right. I would say somewhere closer to 9 months to a year is probably better. What's ideal? If you had 3 to 5 years to plan, that would probably be the best thing. And the reason is you need a couple of tax cycles to get through certain things so that you can line things up. I won't go into great detail about those, but that's much better. You can do it in a year, let's say 9 months or a year, but 3 to 5 years is probably the best. Finding a buyer. What kind of do you think you're looking for? So, and I think this is probably a good time for me to talk about the different, two very distinct deals that I was part of. One that went okay, and then one that I'd say went really, really great. Or I could say this, if it's possible that your employees would consider buying the company, like they want to come together and with probably some equity, not much, but a great deal of debt that's organized so that they can do it. That's not super common, but it's possible. I've seen one of those try to get organized, but it didn't go all the way through. Again, family, moving it up to another generation, but these two deals that I want to tell you about are distinct. Strategic buyers. There's two kinds of general buyers when we talk about going through a corporate transaction. There's strategic and there's financial. So strategic is somebody who has some sort of synergy with you. They're either a direct competitor at your level, they're a direct competitor but they're much bigger. They could be in the same space in some way, maybe not competing with you, but they want your market. They want some channel or distribution that you have that makes sense to them. The strategic deal that I went through had to do with insurance and underwriting. And the founder was he was bent on getting it done himself. He said, I don't want to go through bankers. I don't want to do this. I don't want to pay those fees. And I said, well, sir, what if those fees meant that you could double the value? That those fees wouldn't mean that much at the end of the deal. I don't want to do it. So he spoke to about, I keep thinking it's between 3 and 5. I think it was 4 or 5 different companies that he found himself. And he, tried the first one. They couldn't agree. Second. Anyway, he selected the one, they got on either side of a table, beat their chests and beat the table, and finally agreed and went and had a beer, if you will. And it wasn't a bad deal. I mean, he did get good value. His EBITDA, earnings before interest, taxes, depreciation, and amortization, at the end was about $3 million. He got a multiple of 8. All right, and that deal was worth $24 million for those companies, the underwriting and the insurance. Now, and I want to talk a little bit about different ways that a deal can transpire. You can, and I'll probably mention it on another slide, but you can come all the way out. You can stay in to some degree. You may come all the way out, but they want to contract with you to have 3 years as an executive on site because you kind of know what's going on. They don't want anything to go bad. In his deal, they wanted him to, they called it an earnout. So basically 2/3 of the value was paid. Here's your check on the closing day, but that last third was held and would be earned out over a 3-year period. That worked out very good for both of them because there were some synergies, and this company brought great resources to really sell what they were doing much better. So this company was going to benefit from this channel they didn't have. This founder I was working for, he was going to be able to increase sales, and so his net value of that last third was growing over that 3-year period. He ended up getting more than 24. He probably got, I don't know, 26 or 27 or something like that. Now, what I tell you about this deal before I move on to the next one is that between the accountants and I who were on the deal, we pretty much agreed that he left somewhere between $5 and $10 million on the table.
Ouch.
That's too much on a deal that size. And if he would have gone through a sophisticated process like I recommended, he'd got that money. But he wanted to do it himself. And again, like my attorney friend in Atlanta, why do people tell 4 or 5 people when they want to sell a business, but they'll tell the world if their house is for sale? It doesn't make any sense.
Yeah.
There are reasons where you would want to keep things confidential, either because of employees or your customer base and that sort of thing. But as I tell you about the second deal, I'll tell you how thin those hopes really are, because the word gets out, okay, one way or another.
Yeah. And it can be scuttlebutt, it can be derogatory, and people can leave the company. You know?
Right. In the second deal, and I put private equity group, because in general a financial buyer is more interested in your cash flow. They may not understand what you do at all, they may not compete or even work in your space. In this particular case, the company that, last deal I did that I'm talking about, they had software companies. That's what they did. They bought software companies. They had 7 in their portfolio, we were number 8. And they were software companies that did very different things, right? They had one that was in alcohol distribution, one that was in credit card processing. I can't remember a couple of the others right now, but just very, very different businesses. But what they liked was monthly recurring revenue. They understood it, and they understood the way software companies who were what they call SaaS, software as a service, something where you have to log in or use it, but you never really own it, and so people have to keep paying for it. That's what they like that. So they bought our company. We went through a sophisticated process in this case. We went through an investment banking firm out of Atlanta. They proposed to 213 companies, not 5.
Mm-hmm. Wow.
Half of those people submitted NDAs so that they could get the confidential information packaged, because at that point nobody knew what the company was. We were just a project on the Atlantic coast. Pretty much all of those folks who had NDAs submitted an indication of interest, which was some first value on what they thought they might want to pay. We basically took the top 12 and we met with all of them. So and the board, there was no CEO at this point, I can come back to that later, but I fielded all the questions with the buyers, their representatives, their attorneys, their accountants, and that was over a couple month process, always on the phone, talking, discussing, going through the pre-due diligence, if you will. When we had met with them, they came back. The next step was letters of interest, and that showed how they were going to adjust their price. Well, everybody's price went up. Not tons yet, but it went up, considerably. In the last 5 business days of that,
I'm sorry, when you said LOI, you said the price that they were willing to pay for it went up?
Correct.
Out of the 12, the
Yep.
12 all said we'll pay more?
All elevated from their own indications of interest that they'd be willing to pay more once they had met with us.
Gotcha.
So it was like IOI, we selected the 12, we met with them, and then the LOIs came back and they all elevated.
Okay.
And I don't want to take too long because I want to make time for everything else, but we basically went, the last 5 business days, I would say, it was like an eBay auction. I told the board that I was pretty sure we were gonna get over 100 million for the company, and they're like, no way, no way. The bankers came in and said, well, we think 53 to 71 is probably
Your
the
best
sweet
value,
spot,
yeah.
right? And I didn't say this to the group the other day, but I'll say this because I just remembered. There was one company that once it kind of hit that street, not the street, but people who were in the know, they came hard and fast to the table and said, hey, we're gonna give you $60 million. It was right in the middle. Before we even went through this process, so I'm backtracking a little bit, okay? And so the board, and this is a young board, they were in their 30s, all right? Because Dad started the company, Dad got sick, had strokes, and then it was theirs. Between those 3 adult children, they owned 60% of the company, so they controlled it, and they were the board. And they said, yeah, no, we're gonna pass. 2 days later, it comes back 65. No, we're gonna go ahead and pass. 2 days later, he comes back with 70. Well, 2 of those siblings said, look, maybe we're already at the top of what the banker said, maybe we should get out. And I told them, I said, do not do this. I said, do you realize what's happening? I said, this guy's coming at you hard and fast. I looked at one of them, I said, he's got your cell phone number and he's in your ear and he wants to get this done. He told you when we met with him, because we did meet with him on one day, way early, and I'm backtracking, and said, you know, he hits home runs all the time. He'll take a company and over a few years make it, 5-fold, 10-fold value. I said, what do you think he's going to do? I said, he's looking for a grand slam, and you're going to give him one if you sell it. I said, you have not made a market for your company yet. Nobody knows, or not enough to really make a decision. It's too early. Yes, the bankers have started their work, but these guys have come in before anybody's replied. Why would you do this right now? The oldest sibling was the one that put their foot down. The other 2 actually were upset with me for about a week or 2 because that one decided, no, we're not going to take the offer. Because they were like, oh my gosh, what have we lost? Well, at the end of the day, so now I'm going all the way back forward again. In that 5 business day period at the end, there were 4 companies who literally turned it into an eBay auction. They went 100, 110, 120, another one went 132, and the last one went 142. These were all private equity groups who were heavy software invested. I didn't think it was going to go that far, but it literally ended up double what they expected. Advisors, and I'll talk about all these. This one's kind of an interesting one and a new one I'd mention. Brokers, there's business brokers who will, they've got a Rolodex. They're basically going to get on the phone and try and find that network of people that makes sense to find more of a synergy that will help you, buy your, purchase your business. Investment bankers have a deeper Rolodex, and they're going to be more connected to private equity groups and other larger, I would say their Rolodex is bigger. They're going to have more opportunities to bring someone forward. Their fees are going to be more. But, in this case, the last deal, that fee was about $5.5 to $6 million. Well, that's not a whole lot to pay on 142. I think it was worth it to get away from 70. So, attorneys, transaction attorneys also have, they know these other guys, right? It's a network of people who are all doing this kind of thing. That's their industry, so that's not a bad source. A negotiator is interesting. I would say I'm somewhere between this one and this one. I'm definitely not that, and I'm not that. And one of my most recent clients, they had a company that's been courting them. And they have somebody who's their advocate. He's kind of like their negotiator to help them go and acquire my client. Well, they're basically engaged me to be their advocate or negotiator, if you will. I'm not brokering anything, the deal's already kind of there, but I'm going to come forward to compete with that guy and say, okay, well, this is why we're basing our value. This is why these guys need the price that they do. So Yeah, so, and again, in the first deal, there was none of these. He just went and did it himself. In the last deal, they used this one. And I'd say that was a very, very successful event. Right? Because if you really want to present best, you have to have 5 years of accurate, properly revenue recognized statements. Right? The balance sheet, the income statement, cash flow, all have to foot. In the deal I did in November last year, they literally pulled invoices. They said, show us that invoice of that client at that period. All of that has to completely foot. In addition to having spreadsheets that cross-reference customer by geography, customer by product line. I mean, and all of it has to work. If there's anything that's off, if anything is deemed inaccurate or not quite perfect, they start chopping at it. Well, what about that? Well, let's go digging deeper, because if we find a hole here, we may find another.
Yeah.
It smells. Might be the whole thing. Yep, that's the whole thing.
Good.
So, lots to think about. I hope that was helpful, and as I've told everybody, I really like talking about this stuff, and I want to be helpful to you guys. So if you want to have lunch or something like that, I'm happy to do it and tell you everything I can.
Great. Good job.
Thank you so much.
Very good. Yeah.